Welcome to the deep dive. We sift through the sources you provide, cutting through the noise to bring you the insights that really matter. Today, we're diving headfirst into something that's got the financial world buzzing. It's a prediction from Fundstrat's Tom Lee, a name often linked with market foresight. It's forecasting Ethereum, ETH, could hit a staggering $15,000 by the end of 2025.
Yeah, 15,000's huge number.
Huge. And, it feels like more than just a bold claim. It's this glimpse into crypto's potential future. So, our mission today is to unpack that forecast and maybe more importantly, explore 3 different ways you might get exposure to Ethereum. We'll break down the pros and cons. Owning ETH directly, investing in an Ethereum ETF, and putting money into a company called Bitmine Immersion Technologies, BMNR, the goal. To give you a really clear picture of each option so you can figure out what fits your own investment strategy. Ready to jump in?
Absolutely. And what's really interesting here isn't just the number, like you said, it's the conviction behind it. Lee made this call with Fundstrat's head of digital asset research, Sean Farrell. And Farrell actually called Ethereum the biggest macro trade over the next 10-15 years.
Wow, that's quite a statement, not just a short-term bet then.
Exactly. It suggests they see something fundamental shifting. This isn't just a guess. They believe there are real drivers pushing Ethereum forward.
Okay, so beyond the headline number, what are those core factors? What's really driving this bullish view? It feels like we're moving past pure hype.
Yeah, I think so. The first big one is regulatory progress. Things are getting clearer. We're seeing initiatives like the Genius Act, the SEC's Project Crypto. They're trying to provide legal clarity for stablecoins, for staked token yields.
Right, basically setting the rules of the road for digital assets.
Precisely. And that kind of predictable framework, well, it's like a green light for the big players, for institutional money. It turns potential into something they can actually act on.
So clearer rules bring in the bigger investors. Are we seeing that happen now? Is it translating into actual growth?
Definitely. It's fueling a surge in institutional adoption. Just recently, spot ETH ETFs pulled in over, $2.2 billion in inflows in just 1 week.
2.2 billion in a week. That's significant.
It is. That's not just retail excitement.
Okay.
Beyond the ETFs, look at the network itself. Ethereum's on-chain activity is strong, near all-time highs, around 1.76 million daily transactions. Plus, it still dominates DeFi, decentralized finance. It holds over 60% of the total value locked there. That's about $96.5 billion. Shows real utility, real value locked in.
And we should probably mention the merge, right? Back in 2022, that shift from proof of work to proof of stake.
Oh, absolutely. That was huge.
Made it much more energy efficient, addressed a major criticism, scalability improved too. Seems like a key step for long-term growth.
Definitely a foundational piece. And this growing institutional interest, it's not just ETFs, it's also leading to things like specialized corporate treasuries.
Like Bitmine Immersion Technologies, BMNR, the one shared by Tom Lee himself.
Exactly. They made a strategic shift, moving from Bitcoin mining to becoming a major Ethereum treasury firm. They hold a lot of ETH. Over 1.5 million ETH, last I checked, valued at over $6.6 billion.
Wow.
And their goal is ambitious. They want to acquire 5% of the entire Ethereum supply. They're actively raising capital, huge amounts, to buy more.
Okay, so that sets up our third option nicely. But let's start with the most fundamental one. Option 1, owning Ethereum directly. What does that actually involve?
Right. Direct ownership means you hold the actual digital asset, the ETH itself. Not a claim on it, but the real thing. This gives you true ownership, and you can interact directly with the Ethereum blockchain. No middleman. It's the purest way.
Okay, so how does someone, actually go about getting direct ETH? And what are the key choices they face right away?
Well, you can buy it on centralized exchanges. Think Coinbase, Binance, Kraken. Those are usually pretty user-friendly. Or if you're a bit more crypto-savvy, you can use decentralized exchanges, DXs like Uniswap or Jupiter. That's more peer-to-peer.
And once you have it, where do you keep it?
That's the big decision. Storage. You can go for self-custody. That means your own wallet. It could be a hot wallet on your phone or computer for easy access, or a cold wallet like a hardware device for more security, especially long-term. With self-custody, you hold the private keys. You are the bank.
The keys being the crucial password, essentially.
Exactly. Lose them, you lose your crypto. The alternative is leaving it in a custodial account on the exchange where you bought it. Convenient, but you're trusting them.
Being your own bank sounds powerful. What are the main advantages of going direct?
The biggest pro is that full ownership and control. It's yours. You can send it, trade it, 24/7. And crucially, direct ownership is the only way right now to get staking rewards.
The yield.
Right. You can stake your ETH, help secure the network, and typically earn around 3-4% annually. You can also get into liquid staking protocols, adds flexibility in DeFi.
And you mentioned DeFi.
Yes, full utility.
Yeah.
You can interact directly with decentralized apps, NFT marketplaces, all the stuff built on Ethereum. You're part of the ecosystem. Plus, 247 liquidity. Move value globally in minutes.
Okay, maximum freedom, potential yield. Sounds great. But what's the catch? What are the downsides, the risks people need to understand?
The big one is security responsibility. It's huge. Managing private keys safely has a steep learning curve. Lose your keys, get phished, make a mistake. Your ETH could be gone permanently.
And we saw examples of exchange risk too, right? Like FTX.
Exactly. The FTX collapse in November 2022 is a stark reminder of counterparty risk. If you leave your assets on an exchange, you're trusting they won't fail or misuse funds.
So not your keys, not your crypto really applies here.
It really does.
Yeah.
Then there's volatility, 247 price swings. And sometimes, during extreme volatility, exchanges can even go down, so you can't trade when you might want to most.
Fees too.
Yep. Network gas fees for moving ETH on the blockchain. These can spike unpredictably, sometimes costing a lot for a single transaction. Plus, trading fees on exchanges, maybe 0.1% to 1%.
And taxes, how does that work?
ETH is treated as property for tax purposes, so you realize capital gains or losses when you sell or exchange it. But here's a key point. It is not subject to wash sale rules.
Ah, that's interesting. Unlike stocks.
Right. It means if you sell ETH at a loss, you can potentially buy it back immediately and still claim that loss for tax purposes in that year, which can be a strategic advantage in volatile markets. You can't do that with stocks or ETFs, subject to wash sale rules.
So direct ownership, pure, powerful potential yield, but you absolutely have to be your own security expert and manage that volatility and tax complexity.
That sums it up well. It demands responsibility.
Okay, that's a lot to weigh. If that direct approach feels like maybe too much responsibility or too complex, what's pathway number 2? Especially for folks comfortable with traditional investing.
That leads us right into the Ethereum Spot ETF. This is the alternative many traditional investors have been waiting for. These are regulated investment funds. They actually hold real Ethereum, usually in secure cold storage with a custodian. When you buy a share of the ETF, you're buying a piece of that underlying pool of crypto. It's managed for you. And the SEC gave the green light for the first U.S. spot ETH ETFs in July 2024. Big deal.
And the main appeal here is simplicity, I imagine. How easy is it for the average investor?
Extremely easy. Getting exposure is just like buying any other stock or ETF. You do it through your regular brokerage account, Fidelity, Questrad, whatever you use. And a major plus, you can hold these ETFs in registered accounts. Think IRAs, 401ks in the US, or RRSPs, TFSAs in Canada. That offers potential tax advantages you often don't get as easily with direct crypto. Fits right into your existing financial setup.
So super simple, accessible, fits in tax-advantaged accounts. Those are big wins. But what are the trade-offs? What do you lose for that convenience?
The biggest disadvantage, and this is really important, is no staking rewards.
Ah, okay, so you miss out on that 3–4% yield.
Exactly. Current U.S. spot Ethereum ETFs are specifically barred from staking the underlying ETH. The SEC has concerns, likely related to the Howey test.
The test they use to see if something's a security, right?
Right. So no staking yield for ETF holders currently. That's a significant opportunity cost compared to direct ownership. You also have fees, annual management fees, the expense ratio. These vary. Grayscale's ETH is higher, like 2.5%. But many of the newer ones, like Franklin's EZT or iShares ETH, are much lower, around 0.19% to 0.25%. And many have temporary fee waivers to attract assets.
Still, even a small fee adds up over time. It chips away at returns.
It does. Another thing is the trading hours.
Right. Crypto trades 247. Stocks don't.
Precisely. ETFs only trade during traditional stock market hours. So if ETH makes a big move overnight or on the weekend, you can't react until the market opens. This can lead to price gaps between the ETF and the actual ETH price.
And you can't actually use the ETH represented by the ETF shares, can you?
No, you can't. You can't use it for staking yourself, obviously. You can't use it as collateral in DeFi protocols or to buy NFTs or make payments. It's purely a way to track the price.
So it's about price exposure, not utility. What about taxes for the ETF?
Tax-wise, these spot ETFs are structured as grantor trusts. This means the underlying ETH is still treated as property, just like owning it directly. So capital gains or losses on sale, and importantly, also not subject to wash sale rules. You keep that tax loss harvesting potential, and the reporting is simpler. You just get a standard 1099 form from your broker.
Okay, so ETFs, simple, familiar, regulated, fits in tax-advantaged accounts, no wash sale rule. But the big trade-offs are no staking yield and limited trading hours, no direct utility.
That's the core trade-off. Convenience and regulatory comfort versus yield and utility.
Got it. Now, what if someone wants something different, maybe combining crypto exposure with the stock market, but looking for potentially more upside, or maybe more risk? That brings us to option 3, investing in Bitmine immersion technologies or BMNR stock.
Right. This is buying shares in a publicly traded company, BMNR, on the NYSE American. Their whole business, their balance sheet, is heavily tied to Ethereum.
Yeah.
So the value of your investment is affected by both how the stock itself performs and how the price of ETH moves, because they hold so much of it. It's kind of a hybrid exposure.
And BMNR's strategy sounds intense. What makes it appealing and maybe what makes it riskier than the other options?
Well, it's definitely got Tom Lee's influence. They pivoted from Bitcoin mining to become this massive Ethereum treasury. They're arguably the world's largest holder now, over 1.5 million ETH, worth, over $6.6 billion. And their goal, acquiring 5% of all ETH, that's huge. They're funding it with massive capital, raises like a $24.5 billion stock offering announced.
24.5 billion.
Billion, it's aggressive. Plus, they are staking their ETH, aiming for 4-6% annualized returns, they say, under SEC-compliant structures. Like an ETF, you buy the stock through a brokerage, can hold it in registered accounts.
So what's the main pro here? Why choose this route?
The potential for amplified or leveraged exposure. Because their ETH holdings are so large relative to their likely market cap, and because they're actively growing that treasury, the stock price could potentially move more dramatically than ETH itself. If ETH rallies, BMNR might rally even harder, or fall harder, of course.
Like a leveraged bet on ETH, almost.
In a way, yeah. Though it's driven by their treasury size and operations, not direct leverage in the financial sense, it also offers that familiar stock market integration. And they've got big names on their advisory board. Joseph Lubin, Peter Thiel, Cathie Wood's backing mentioned. That signals some institutional trust. Plus, their focus on immersion cooling, green energy, plays into ESG trends.
Okay, so potential for amplified moves, traditional market access, some institutional signals. But that leverage, that amplification, usually comes with extra risk, right? What are the downsides specific to BMNR?
Absolutely. You face significant company-specific risk. This isn't just about ETH's price.
Yeah.
Poor management decisions, maybe too much debt from those capital raises, operational screw-ups, and shareholder dilution. That's a big one.
Dilution, meaning they issue lots of new shares.
Exactly. To raise that capital, they issue stock. Their share count apparently expanded 13-fold since just 2023. That can put downward pressure on the existing share price.
15 times.
Yeah. And remember, it's indirect exposure. You don't own the ETH. You can't use it on-chain. Like ETFs, trading is limited to market hours.
Yeah.
You miss the 24/7 crypto action. There's also maybe some regulatory exposure risk if their strategy relies heavily on specific interpretations or connections, and those shift. It could impact them.
And taxes. Is it like the others?
No, this is different. BMNR is a stock, so it's subject to standard equity tax rules. That includes the wash sale rule.
Ah, okay, so you lose that tax loss harvesting flexibility you get with direct ETH or the ETH ETF.
Correct. That's a key distinction.
So BMNR, potential for amplified ETH exposure via stock, but layered with significant company risks like dilution, debt management, plus wash sale rules apply.
That's the essence of it. High potential reward, but definitely higher and different types of risk.
Okay, we've really dug into these 3 paths: direct ETH, the spot ETH ETF, and BMNR stock. If you're listening and trying to decide, how do we boil down the comparison? What are the key trade-offs?
It really boils down to control versus convenience, first and foremost. Direct ETH gives you maximum control, maximum utility staking, DeFi, all of it. But high personal responsibility for security, more complexity.
Total control, total responsibility.
Oh, right. Then the spot ETH ETF, high convenience.
Yeah.
It's in your regular accounts, regulated, but you give up the staking rewards, you give up the on-chain utility.
Convenience, but less crypto-native functionality.
Exactly. And BMNR stock tries to blend crypto exposure with the stock market, potential for amplified moves, but it's indirect, and you take on all those company-specific risks on top of the crypto risk.
Okay, control versus convenience. What about costs and rewards?
Direct ETH. You pay transaction fees, network gas fees, but you get the potential for those 3-4% staking rewards. Spot ETH ETF. You pay the annual management fee, the expense ratio. And critically, no staking rewards, that's the opportunity cost, BMNR stock. You pay stock trading fees. The company itself has operational costs, like commissions on those huge capital raises, but they aim to generate yield from their own staking, which theoretically benefits the stock price.
And the risk profiles side by side.
Direct ETH, pure crypto market volatility, plus that self-custody risk. If you mess up security, it's on you. Spot ETH ETF. Crypto market volatility plus some fund management risk like tracking errors, maybe fees changing, and those market hour gaps. BMNR stock, crypto market volatility plus company risk debt, dilution, management decisions, plus general stock market sentiment. You're layering different kinds of risk.
And finally, that tax difference again, just to be clear.
Crucial difference. Direct ETH and the spot ETH ETFs, as grantor trusts, are treated like property. Capital gains losses on sale. No wash sale rules. Big plus for tax management. BMNR stock is a security. Standard stock tax rules apply, including wash sale rules. You lose that immediate tax loss harvesting option. ETFs do make the reporting simpler with the 1099s, though.
Right. Okay, we've really unpacked Tom Lee's big $15,000 ETH call and explored these 3 ways to potentially get exposure. Owning it directly, using an ETF, or investing in BMNR stock. Each clearly has its own mix of control, convenience, risk, and reward.
Absolutely. And the best way, it totally depends on you, the listener. It depends on your comfort level with the technology, with managing security. It depends on your investment goals, your tolerance for risk, how hands-on you want to be.
Do you want to be deep in the crypto world, earning yield, using DeFi?
Then direct ownership might be for you if you accept the responsibility.
Or do you just want simple price exposure in your existing brokerage account with regulatory oversight?
Then the ETF looks attractive, even without the staking yield.
Or maybe you're looking for that potentially higher amplified upside and you're willing to take on the extra company-specific risks that come with something like BMNR.
Then that might be your path. There's no single right answer. It's about matching the option to your individual situation.
So as we wrap up, here's a thought to consider. Ethereum seems to be climbing the institutional ladder. Regulations are slowly evolving. How might things change? Could we see future ETFs allowed to offer staking? How will the growing influence of huge corporate treasuries like BMNR reshape things? It makes you wonder if this will change not just how we invest in crypto, but maybe even what ownership really means in this digital age. Something to think about.